Well, goddamn, the market continues to show growth. Now, heading into this lockdown, I'll be honest with you, just like many others out there, I was quite bearish about this whole situation. But we had trade wars that came in. Did that stop the market? Kind of, not really. How about slapping some tariffs on that? Nah, bro, we good. And now we've got a pandemic that doesn't even seem to be phasing the market in the slightest. Don't worry about low corporate earnings and debts being at an all-time high for many of these companies, diluting shareholder value. Because in the ASX at the moment, there's no such thing as a bad day. And what we're currently seeing is a massive trading frenzy. Now, this trading frenzy has actually produced a lot of data, which I wanted to go through. So today, I'm going to go through the most traded stocks in the month of May in 2020 during the pandemic, whilst everybody's in lockdown. Now, the report that we're looking at is made by Commsec, and I understand this is just one broker, but it is one of Australia's biggest online brokers. So one could argue, and I'd say that it's rather safe to make the claim, that the data set that it's providing is rather accurate and probably correlates with many of the trades that we've seen in other brokerages in Australia also. Guys, I'm just editing this video and I can't believe I forgot to ask you to smash that like button. This one's going to be a banger. Anyways, I'll let you guys back to the video. Okay, so on to the first stock. It's actually going to be, drumroll please, Webjet, which I'm not surprised about at all. Considering how much it's plunged, I expected travel stocks to be in one of the top 3 of this list. Now, Webjet in particular has taken a massive dive due to the rona. And for Webjet, that's 75% plunge from its highs in earlier 2020. Now, if we have a look at their response to the rona, well, they basically just raised more money. And they did this by raising $350 million to strengthen their balance sheet to see this bad time out when there are travel restrictions in place. Now, with the travel restrictions, it's not only airlines or travel agencies we're dealing with. At the moment, there's a lot of drama and whatnot going in between the different states. Some states wanting to open up their borders to welcome tourism, some not. And then, there's biff in between all of that that's going on too. But I get it. We're all trying to protect each other just from being infected, from travelers, from interstate. Personally, I think it's a little bit too early to be lifting these travel bans and to have people traveling just even interstate. But if it's going to be the case, I hope everybody, including you there watching this at the moment, follows the rules and takes precautions accordingly. Anywho, so there has really been no updates from Webjet, but their shares have gone up 49% since April. So it's been a massive moneymaker for many people. But what I will say is that the price rise has also been due to the demand in the stock, which is why you see it at, number 1. Along with Webjet in 5th place, we actually have another travel agency also there. And you've guessed it, because there's really only 2 players at the moment. It's Flight Centre, who also saw a plunge of about 75% from their all-time high. Now, they've made some drastic changes in order to be more efficient, given they have much greater overhead than Webjet. Now, given that one is at number 1 and the other one is at number 5, we can go back and forth and have this debate and discussion as to why Webjet's being overbought in comparison to Flight Centre, of which I made a video to both, by the way. But just think of it from a buyer's perspective, right? Like you, the buyer of the stock, okay? So when we're looking at a company, we're looking for its future trajectory, where it's going, because that hopefully increases its value, which then is reflected within the stock price. And now this is more evident than ever because we've got, the rona on our hand. So if I'm looking at the business that's most likely to grow, and this is where we need to distinguish growth from being big, because Flight Centre is a revenue beast in comparison to Webjet. But if you look at the annual growth, Webjet smashes Flight Centre with less overhead. But with that out of the way, the biggest winner that separates the two is WebBeds, which is Webjet's Airbnb, but in the corporate space, and it's skyrocketed in terms of growth. Now, to be fair to Flight Centre, they'll be okay. They'll be rather safe. They have actually gone through a drastic reduction in overhead and are looking to reduce their monthly expenditure of about, I think it's $200 million down to $60 million a month. Yes, a month. I know, it's crazy. $200 million a month. And you'll wonder why. Oh, but yes, before I forget, they probably fell out of favor also because they forced customers to pay $300 to cancel their trips. Like, especially during a pandemic, people are losing 1 to 2 sources of income. You're going to force them to pay $300 to cancel their trips. Like, doesn't really compute. And so, yeah, they probably lost a few buyers there, but this has been waived, and so they've moved on from this. So yeah, I'll just leave it as is. Now, another stock in the travel sector that's seen a great deal of trading is in Virgin.
Got him!
Just kidding. It's Qantas, of course. Virgin's being sold at the moment and bidders are going through their own things. So Australia's very own airline has also raised capital and has the support of the government to see this all out. Now, I personally have a lot of Qantas points, which I unfortunately can't use, and I can't wait until all these travel bans are lifted, things are safe out there, so then I can actually go and fly overseas, because otherwise these points are just sitting in my Qantas wallet doing absolutely nothing. And actually, given Virgin is still in limbo, that really only leaves one player within the aviation space, which is why we've seen such bullish cases for Qantas with such a high buy-in from shareholders. But you definitely will not be catching me buying Qantas shares. And if you're wondering why not, just check their balance sheets and their cash flow statements and you'll see why. With the highs of the overall market, the stock has jumped back to, as of writing, over $4 from its low of $2.14, which is writing some really big checks for many traders and investors who've done very well in riding this Qantas wave of flight, given it's an airline. Now, the next company that's made it onto the list as one of the most traded stocks within this period is Zippy Dippy. Yes, ZipPay, along with its big brother, Afterpay. Now, I personally see Zip as more of a short-term play for many traders, including myself. Because realistically, there's no way you can sit there and actually tell me that Zip is going to outperform Afterpay in terms of growth and in terms of partnerships, retailers, and gaining market share, both domestically and internationally, after all the work that Afterpay's put in and the position it's put itself in now. And for full disclosure, I do own shares within ZipPay, and I do see them riding the buy now, pay later wave as Afterpay goes up and as many of the other services go up as well. Because, well, there's many ways to create wealth within the market, and there's many ways to skin a cat within this game. So I really have no dislike or whatever towards people who want to take short-term trades. You understand the risk and you go in, and if you are right, then you reap the rewards. If you're wrong, well then, damn, it's a tax loss. Now, as for the buy now, pay later space overall, it's weird because part of me goes, where's the actual moat? Like in my previous video, I looked at the bullish case, I looked at the bearish case already. And although I kind of addressed it there, I still kind of have the inkling, like, why can't any other company replicate this and be just as successful? We see Shopify and PayPal, who've recently just come out with their own equivalent, but in the market that's quite bleak, it seems like everybody loves the prospect of Afterpay being this golden tech child in Australia. And I recently listened to a Motley Fool podcast in the States, and they had been nominating it to be on their watch list also. Now, if you have a look at the numbers there, it seems like 54% of the trades were actually sales. So a lot of people were cashing out and cashing in their profits hard during this time, and that's totally understandable. Now, this crazy rise in price reminds me of a stock of a company that, well, for the sake of not being demonetized, relates to smoking trees in North America, and that share price went insanely high. I think it was like over 300 and something %, and then it crashed down hard and was never spoken about ever again. Now, I'm not saying Afterpay is in the same boat, but you just never know what the market's gonna do. Now, for the last sector within this list and the largest in the ASX by a long mile, of course, I'm talking about the finance sector, of which buy now and pay later kind of belongs in here, but they're more fintech than actual traditional finance. So if we look at the chart, we can see now that the big four banks all are within this list, and Macquarie Bank is just hanging in there at number 10, with the big four banks having gone down drastically. And I'm not even sure how they're going to recover from this and make it back to their all-time highs, given they're quite reliant on the home loan market, and rates are at an all-time low in Australia, with the potential of going into negative interest rates, which I really don't even know what the repercussions for that is. So with all that being said, essentially they just need to look elsewhere for profits. And now, again, for full disclosure, I do own Westpac and many of the banks also through the ETFs that I've invested in. But hey, if you're a shareholder, hold tight. These are basically government owned at this point. The top four won't fail. And I'm not surprised at all seeing them in the top 10, given the volume and the low share prices they're at. Now, if you want to have a peep at the rest of the list, because this is a top 20 list, you can see some in retail and Kathmandu and Myers. I like both brands, but I wouldn't invest in either of them. But more importantly, look at number 20. In number 20, we have a bear ETF, which is good for risk mitigation, but I hope people have cashed out given this crazy uprise surge that we've had in the market. Because at the moment, there's only one direction in which this roller coaster is heading. So anyways, guys, that's the list. Let me know if you want me to make one of these every single month, like a monthly type of thing. It's kind of fun to see what the actual trends are. But that's it for me, guys. Let me know in the comments if your company was in the top 10 list. But apart from that, the Zero video will be coming this week as we close out our wax series. But that's it for me, guys. I'll catch you guys later. Cheers.